This is Chapter 19, Accounting for Partnerships, and I'm going to go through a few examples that are like your homework. So after you read the chapter and you go through the PowerPoint and watch everything like that, then go through these 3 practice problems. Then you should be ready to start on your homework. Okay, so this first one is on working with partnerships and adding someone on, creating the partnership, and then figuring out how much is going to be in each account, each capital account, and then also do a balance sheet. So here we have Edmund Veal. He operates a store that sells paintings and portraits. He agreed to enter into a partnership with Sarah Cobb, and this is effective January 1st, 2019. The new firm will be called Artist Supply Company. Veal is to transfer the assets and liabilities of his business to the partnership at the values agreed on, which is listed in the table. Cobb is going to invest cash that is equal to Veal's investment after the revaluation. Okay, so let's work on number 1, which is to prepare the journal entries to record the following transactions. The first thing we're going to do is the receipt of Veal's investment of assets and liabilities. Okay. So as you can see, cash is at $36,000. So that's what he's bringing. So that's what he's bringing into the partnership. So there's going to be a debit to cash for $36,000. And then a debit to accounts receivable for $36,000. Next is inventory. Inventory is valued at $344. And furniture and equipment is valued at Furniture and equipment is actually valued at $95,200. That's what was agreed upon. It's on his books at $216, but they only agreed upon $95,200. So furniture and equipment is $95,200. Okay, and then allowance for doubtful accounts is actually $8,800 as a credit. Allowance for doubtful accounts. I'm going to abbreviate here. And where they get that number from for the allowance for doubtful accounts is take the $32,000 and the $27,000 and the $4,000, and then that is where you get the $8,800. If you take the full $36,000 and subtract $27,200, you get $8,800. You're looking at the difference between the amount in the accounts receivable and the amount that is allotted for the allowance account. Then let's look at accounts payable. Accounts payable is agreed upon to come over at $32,000. And then the capital account, this is how much he has in capital account, is $470,400. And then that's the journal entry for number 1. Then the second part of this is the receipt of Cobb's investment of cash. Cobb is going to invest the same amount that is the total for Edmund. So for that part, you will debit cash $470,400 and credit her new capital, which is Sarah Cobb capital, for the $474,000. So they are equal partners, so they each have an investment of $470,400 in the capital account. Okay, now for number 2, we're going to prepare a balance sheet, and with this new information, with both of their capital amounts and the amount that Edmund brought into the company. So, you're always going to have your 3-row heading. So you will have artists. This is really difficult to write on here. Let's see if this will help. Okay, artists, supply company, and this is a balance sheet. And this is as of the day that they are entering into the partnership, where it stated it was January 1st, 2019. They need to have a starting point. Okay, if you remember from a balance sheet, I know it's been a while, balance sheet is assets, liabilities, and equity. So we're going to start with our assets. And we have cash, accounts receivable, and then of course we have the allowance for doubtful accounts. Our merchandise inventory. And furniture and fixtures, or furniture and equipment, whichever. I'm going to put equipment, but equipment, fixtures, whichever. And then we'll add them together to get our total assets. Okay, our cash is, let me see if I can get this on the same row, is $506,400. And that number comes from the amount that Sarah is investing in the company. She's investing, I'll put it over here, $470,400. And then the amount of cash that Edmund has is $36,000. If you add those together, that is where you get the $504,400. Okay, accounts receivable, if you go back to the problem, accounts receivable was at $36,000. But then we have the allowance for doubtful accounts that they agreed upon of $8,800, which is a net value of $27,200. Merchandise inventory was $344,000. Furnitures and fixtures was $95,200. So then if you add up all of that, you get a grand total of $972,800. Okay, after assets is liabilities, and we have a couple of liabilities here that we're going to list. Actually, only one. We're going to have accounts payable. So let's list our liabilities and accounts payable. Now, because we only have one liability, we do not have to list a total liability section because there's only one. If we had more than one, then we would. Okay, that is $32,000. Then we can list our equity. It would be assets, liabilities, and owner's equity, but because it's a partnership, we are going to call it partner's equity. And I'm going to have to move it up a little bit, and then I'll bring it back down for the end. Okay, so partner's equity. Edmund Veal Capital, $470,400. And then don't forget Sarah Cobb Capital also. She has the exact same amount. Total partners equity, add the two together, is $940,800. Now, you know assets equal liabilities plus equity. So we're going to go ahead and we're going to add the liabilities and equity together, and it should equal total assets. So now we're going to have a line that says total liabilities and partners equity, which is the $32,000 plus the $940,800, and we get $972,800, and it does equal our total assets. Okay, so I'm going to bring this down here so you can see the whole thing. So this is the balance sheet after the partnership is formed, and after Edmund comes in with his cash, accounts receivable, inventory, furniture, and all of that, and then after Sarah's investment as well. Okay, so that was the first one. Now we're going to go on to the second problem, which is some journal entries, and these are looking at closing accounts. Okay, we have Wayne and we have Barney, and they operate a retail furniture store. Under the terms of the partnership, Wayne withdraws $8,000 a month and Barney withdraws $6,000 a month. Okay, let's just figure out what that is, okay? So I'm going to do a couple of T counts up here. Okay, so Wayne, his last name is Beasley, so I'm going to label this Beasley. Okay, here's his T count. And then Coda, which is Barney. Okay, Beasley withdraws $8,000 a month. If you take $8,000 and you multiply it by 12, which is for the year, that's $96,000. Coda takes out $6,000 a month, so after a year, 6 times 12, he would have $72,000 in his withdrawal account. Okay. The withdrawals, which are not considered salaries, were made each month and charged to the drawing accounts. I just did the T counts for those. The partners have agreed that net income and loss will be allocated 35% to Beasley and 65% to Coda. The net income for the year was $420,000. So we're going to have to calculate that. So if we take $420,000 and we multiply it by 35%, that is $147,000. That is how much Beasley's going to get. Okay, then take that net income and multiply it by 65%, and you get $273,000. That is how much Barney Coda is going to get. Okay, I think now we are ready to do a couple journal entries. The first one is to prepare the journal entry to close the income summary account. Okay, sitting in income summary, remember, is the net income. You close out your revenue, you close out your expenses, and what's left in income summary is the net income of $42,000. So I'll just go ahead and do a T count. So in income summary, we have $420,000. We need to close it out. It's sitting there. I'm sorry, it's a credit balance, not a debit balance. Am I able to erase this? Yes, okay. It's sitting as a credit balance, $420,000. So the journal entry, this is 1A. We're going to debit income summary to close it out. And remember, when we were doing the closing entries, we close out income summary into the drawing account. So that is where we're going next. So income summary is going to be debited for the $420,000. And then we're going to have two credits because we have two owners. We have a credit to Beasley Capital for the $147,000 we calculated, and then Coda Capital for $273,000. We just calculated that up above a few minutes ago. Okay, 2B says close the partner's drawing accounts. Okay, I am going to do, 1B, not 2B. 1B right here. We're going to close Beasley at $96,000. When I say close capital, close the drawing accounts. Beasley has $96,000 in the withdrawal account, and we close out with the withdrawal into the capital. So debit the capital because we're reducing the value of the capital because for the amount of money that he withdrew. And since drawing has a debit balance, we need to credit it to zero it out. Then we're going to do the same thing for Coda. Coda withdrew a total of $72,000, so we need to close that out into the capital. So Coda's capital account will be debited $72,000 and then close out his drawing. So for $72,000. A. Close. Okay, assume that there have been a net loss instead of $220,000 instead of a net income of $240,000. So in this instance, let's look at income summary now. Income summary is now going to have a debit balance of $220,000 because it's a net loss. To close it out, we need to credit the account, and then we will debit the capital accounts. So the capital accounts are going to be reduced because there was a net loss. And then take that multiply it by 35% to get the portion of that net loss that Beasley has to take on. Coda is 65%. He has to take on $143,000. Beasley Capital for $77,000. Coda Capital for $143,000. credit income summary for the 220. Now let's do 2B. 2B is to close the drawing accounts with this situation. So the drawing accounts are still going to have the exact same amount in it because the drawing account is only what they withdraw. So this is going to be the same as 1B. It doesn't change. The capital account is different because there was a net loss rather than a net income, but that did not affect the withdrawal account that they used to take money out. Okay, the last one that we're going to do is to look at a partnership already formed, and now they are adding another partner to it. So we have Franklin Winston and Haley Thomas. They're partners. And we have their capital balances of $240 and $320. Profit and losses are shared as a ratio of 55% for Franklin Wilson and 45% for Haley Thomas. The partners agreed to admit Wilson Martin to the partnership effective January 3rd, 2019. We have 4 journal entries that we need to do. And this is going to be admitting Martin as a partner under different situations. So the first one is Winston sells 1/2 of his interest in the partnership to Martin for $176,000 cash. Okay, so that is one. I'm going to, let me see if I can fit this all on this page. Okay. Well, okay. So I'm going to do one right here. Okay, the fact that he sold it to him for $176,000 doesn't mean anything to the business. That is a personal, private transaction between the two of them. The only thing that we need to record as the business is we need to record half of the interest going from Winston to Martin. And if Winston has $204,000 in his capital account and half of it is going to Martin, then that is $120,000. So we're going to oops, I'm sorry, wrong person. We have to take it out of Winston. So Winston capital, we will debit for $120,000 to decrease it. And then we're giving it to Martin. So we will credit Martin's capital account for $120,000. I think I have enough room to do number 2 right here also. Okay, this time Thomas sells half of his interest to Martin for $128,000 in cash. Again, the $128,000 is irrelevant. We're only looking at what portion of the partnership are we taking from Thomas to Martin. Okay, now Thomas has a balance of $320,000 in his capital account. Half of that is $160,000. So we're going to do the same thing, but instead of Winston, it's going to be Thomas. And we're going to give that half to Martin. Okay, number 3, Thomas invests $240,000 in the business for 1/4 interest in the partnership. Okay, so I'm going to do some calculations over here on the side here. Okay, we've got, 1/4 interest. We first need to see how much is in there. Okay, so this is calculations for number 3. Okay, so back to the original scenario. Winston has 240,000. Thomas has 320. And Martin is investing 240. What am I doing? You add that up, you get $800,000. This is how much now is in the partnership. And Martin is getting 1/4 of that. So if you divide that by 1/4, that's 200,000. Okay. This is going to be 2 transactions. It technically can be put into one, but the way we're going to do it is in 2 separate transactions. The first thing we're going to do is we're going to record the cash investment. He invested $240,000, so we're going to debit cash $240, and we're going to credit his capital $240. But he is only getting $200,000 for his investment. So we need to take that $40,000 difference and give it to the other 2 partners. So basically, Martin is paying more for the portion that he's actually getting. So basically, he's paying the other 2 partners $40,000 to allow him in as a partner. So this next transaction is to debit Martin's capital $40,000, and then we're going to credit, I'm going to move this up a little bit, and we're going to credit the other 2 partners to give them their portion of the $40,000. Okay, we have Winston capital, and we have Thomas capital. Now remember, it's not 20,000 and 20,000, because remember that it is split 55% and 45%. It said that in the beginning that the partnership is split 55% to Winston, 45% to Thomas. So we need to take that $40,000 and separate it out by 55% and 45%. When you do that, Winston is going to get $22,000 and Thomas is going to get $18,000. Okay, now for the last one. Martin invests $240,000, same thing, but this time instead of getting 1/4, which actually is 25%, he's getting 35%. So now he's getting more percent of the partnership than in problem 3. And increasing it by 10% changes the scenario. Instead of paying the new partners the bonus, the other 2 partners the bonus, those original 2 partners are paying Martin the bonus. Okay, so let's first record the cash transaction of 240. That's going to be the same as number 3, because he's still investing the 240,000. Okay, now we have that $40,000 that we need to break out. We already know the percentage. The percentage is $22,000 for Winston and $18,000 for Thomas because we calculated that in number 3. But in this transaction, instead of crediting Winston and Thomas the $22,000 and $18,000, we're going to be debiting their capital account because they're paying the $40,000 to Martin in this case. Whoops. Winston capital will be a debit of $22,000. Thomas capital is a debit of $18,000. And then our credit goes to Martin capital. Okay, so for number 3, we took $800,000 and divided it by 1/4. Or you can multiply it by 0.25. You get the same thing. So you could do 800,000 times 0.25, and that's 200,000. That's the same thing, 0.25 or 25%. Okay, so in number 4, we took the 800,000 and we multiplied it by 0.35. And that was, and that is where you get that 40,000 difference on the next way. Okay, these are 3 examples like your homework for chapter 19. If you guys have any questions, please don't hesitate to give me a call. Thank you.